Good evening, ladies and gentlemen. Well, it's a pleasure to be here in Zurich tonight, seeing so many faces out in front of me. When Patrick actually asked me to speak at this event, I thought this is a wonderful opportunity. It's a great honor to come and speak at your event. But then when he told me or outlined the timetable for this evening, I realized that, in fact, I'm the man keeping you from the bar. So I am very conscious of that. So hopefully, in the intervening period between me starting and you going to the bar, that I can provide you with some thoughts about how we view the global markets from CIBC's perspective, and how that relates a little bit back to the gold price. And I will quite rationally say that I'm not a gold expert, but it's interesting to be surrounded in a room with so many gold experts and to hear some of the interpretations and indeed hear some of the questions that were being asked of the gold experts, because hopefully I can address some of those issues in the next 30, 40 minutes or so. And if I don't, then of course there is an opportunity to ask me questions at the end. So, as Paul mentioned, well, I'm talking about adapting to a post-truth world. Now, what does post-truth mean? Well, the Oxford English Dictionary decided in their infinite wisdom at the end of last year that, in fact, post-truth was their word of the year. Now, it seems a little odd because, as far as I can see, it's two words, but nevertheless, that was their word of the year, beating another fairly obvious dynamic word which has been rather relevant for me, being a Brit coming from London, beating Brexit in the process. But in a sense, those two concepts do have a degree of similarity. They do have a degree of interconnectedness, because in a sense, it's talking about this idea that objective facts are no longer so influential in shaping public opinion. It's more about emotion. And in a sense, that's one of the categorizations, or one of the elements that's really been writ large in the way that financial markets, or at least political dynamics which have influenced financial markets, have really played out over the course of the last 12 months, and ultimately could well continue to be a key influence on financial market movements and risk appetite and risk variance over the course of the upcoming months as well. Because, of course, risk variability or risk appetite is important, and it does have important implications for certain asset markets. And if we were to see a very risk-averse market environment for a prolonged period, then of course that has implications for assets such as the gold price, for example. So we are in this post-truth world where we are dealing with emotion rather than the objective facts, and of course that's very notable in terms of the upcoming political sphere and the political relationships in the Eurozone, with those French elections immediately on the horizon, and I'll touch on that a little bit as we go through. But of course, from the broader global perspective, the most obvious elements relate to the US. And of course, Mr. Trump has been the other obvious element in the post-truth world. Of course, it isn't just post-truth, it's alternative facts, it's fake news. This whole gamut of new phrases that we're now dealing with, and which have influence on financial markets. But in the context of Trump, there are a whole range of issues. We've seen, obviously, an enormous uptick in the equity market in the immediate aftermath of his election. Can that process extend? Are we going to see some degree of fiscal changes? Are we going to see changes to the tax code, which are going to encourage US corporates to bring money offshore back into the US, which could have some implications in terms of the FX space? And of course, as we know, the valuation or the variance of the US dollar has important implications for commodity prices. So there's variables in that particular regard. How are we going to see this interaction between the Trump White House and NATO? Well, of course, the mood music hasn't been particularly encouraging on occasions. And in a week when Mr. Trump is meeting the Chinese premier, and after the rather public relations disaster of his meeting with Angela Merkel a couple of weeks ago, it will be fascinating to see how these sort of interrelationships play out. And of course, there is the other element in terms of energy prices. Now, it's not so relevant perhaps for this forum, but obviously working for a Canadian institution who do have extensive interest not just in gold and mining, but also in terms of the energy sector, I think there is going to be an important implication in that regard as well. So what are the key thoughts? What are we thinking? Well, the Fed is clearly an element which is relevant. I think it is relevant absolutely in relation to the question from the lady earlier in terms of how the US interest rate cycle is going to play out. And of course, Janet Yellen has less than 12 months left in tenure as the chief of the Fed, or the Federal Reserve chair. One assumes that Mr. Trump will not reappoint her for another term, and one assumes that even if he offered her the position, she wouldn't take it. So one suspects that we were going to see additional political appointees coming into the Fed range of outlooks over the course of the next few months. But as it stands now, we are expecting probably at least another 2 hikes from the Fed coming through this year. So we're not going to see a repeat of the mistakes of 15 and 16 when the Fed left policy on hold throughout the year, when they had ample opportunity to tighten and then had to rush through 1 hike in December. We've obviously seen the Fed already getting somewhat ahead of the curve by hiking in March. I think the market is underplaying the risk of another hike to come before the middle of the year, and then we may well see 1 further hike this year in the latter stages of the year, and we will probably see something similar in 2018 as well. Now, that does say that in the environment of higher interest rates from the US, that does cause challenges for the asset markets, and particularly for the gold price. But as I'll come on to, that doesn't necessarily tell us the whole story. But nevertheless, I think we are going to see a gradual tightening of monetary policy, but we're not going to see US interest rates north of 2% until probably 2019. Does that matter? Well, it does, because, of course, it probably means that real rates are still going to be negative out for the next, majority for the next year, maybe even 2 years. Now, in terms of the context of the Fed, I think there is going to be a case that the Federal Reserve itself is probably not going to be that concerned by the dollar's performance, how the dollar reacts to this prospective interest rate cycle. Whilst the Fed may not be concerned about it, the US administration clearly will be. And I think that's going to be the other sort of variable which is going to be overarching the Fed's outlook. What's going to be the political dynamics that are going to come with that? Because, of course, if we are going to see this continued mantra about making America great again from Mr. Trump, as we saw on the campaign trail, and as he continues to effectively campaign now that he's in the White House, an overly strong dollar doesn't necessarily fit or is conducive to that particular problem. So that's one issue to consider. What about some of the other issues? Well, we've had an environment for the last 7, 8, 9 years where effectively monetary policy globally has been remarkably easy. We've all become accustomed to effectively zero interest rates or something very close to that. And not only that, we've seen a number of central banks injecting liquidity into the financial systems under the QE process. We've seen it in the UK, we've seen it in the US, we've seen it in Japan and other nations as well. Now, the question is, are we going to see this process gradually reversing over time? I think ultimately we are. And I think that also has some implications for global financial markets as we go through over the course of the next couple of years. Now, what about risk aversion? Well, risk aversion variability. Now, I'm going to show a chart in a moment just to sort of graphically illustrate that. But this time last year, we were just coming through an equity market meltdown led by China, albeit you could argue that the Chinese equity market capitulation had absolutely nothing to do with the broader economic outlook in China. It was very much a leveraged private investor reversal, so not really telling us anything about the Chinese economic system. But we had that equity market uncertainty, which really caused a degree of risk aversion in the early part of last year. Then we moved on into the Brexit process last summer, so the vote in June, that again created a significant period of instability. Now, the question is, are we going to see these episodes becoming more protracted or pronounced, or are they going to be very temporary and short-lived? I think probably the answer to that question is they will still be relatively short-lived, and that's partly due to this presumption of whenever there are episodes of uncertainty, there is this presumption that the central banks will come and ride to the market's rescue. So there is still this presumption of ongoing liquidity, maintaining a degree of stability in financial markets. But we are going to see these ongoing episodes of instability ahead. Now, what about the sort of the global backdrop? Because it is a relevant dynamic. It is an important constituent part in terms of the global recovery process. And I'll put some graphic numbers on this in a moment. But we are seeing a better economic environment in calendar year 2017 than we've seen for the last couple of years. But there are obvious headwinds and uncertainties. And of course, once again, those largely relate back to the US, and they relate back to this idea of protectionism, trade barriers, trade concerns, ripping up those global trade discussions and moving back to much more a bilateral process. Now, I think that isn't conducive to global growth if we were to see the extreme case scenario really playing out. And I think if we think back to the Trump candidacy when he was on the campaign trail, talking about the US winning and getting back to winning, and really the definition of a US win would be a loss for somebody else, Well, in the binary, while Trump may view everything as rather binary, in real terms, trade is rather different to that. It is not a case of saying, well, if I win, you lose. It's possibly the case that if there were to be an imposition of trade barriers, then, of course, it will be the case of who loses least. That's going to be the dynamic, rather than necessarily seeing overt winners and losers. So trade protectionism is an obvious and real concern. I think it was something that we were very mindful of if we go all the way back to 2009, in the immediate aftermath of the global crisis. At that point, the international community pushed back against the idea of trade barriers and protectionism. Now we are perhaps in a scenario where those risks are rather real once again. So what are the real tail risks? Well, I've picked out sort of 4 or 5 here just to think about. Well, US politics is an obvious one, so I've just been touching upon that. And in a sense, I think one of the reasons or one of the factors that markets are really holding upon after November was the fact that we had Republicans sweeping the board in terms of the US administration. So we had both houses on Capitol Hill, and we had a Republican in the White House. So clearly, QED, it should be a relatively easy legislative backdrop for the Republicans going through in the early stages of this administration. Now, of course, the debacle over the healthcare or the repeal of Obamacare a couple of weeks ago underlines the fact that there are very different and divergent views within the Republican Party, and you could also argue that, of course, Trump campaigned on a Republican ticket, but is he really a Republican per se? So in a sense, I think there are some uncertainties in terms of the political backdrop on that particular basis. And I think there has been a presumption that the significant uptick that we've seen in equity markets over the course of the post-election period in the US has discounted pretty much all the good news. So we've seen the banks, for example, getting a good uplift on the presumption of a significant rolling back of regulatory reform. Now, Trump was once again talking up regulatory reform in the banking sector this afternoon. The question is, how real or how realistic is that going to be? And I think, in a sense, we've seen these discussions about the border adjustment tax. Again, I think there is a lot of talk, but I'm not necessarily convinced that the absolute reaction will be quite justifying the talk. So in that particular context, that's one risk. Monetary policy failure is another. So in a sense, you could argue that the Federal Reserve should have been tightening a little faster over the course of the last couple of years. We could make the argument, and I think it would be rather a relevant one, to say that with the US unemployment rate at the levels it is, then is the Fed perhaps a little bit behind the curve? Should they have been acting a little bit faster? So I think there are question marks in that regard in terms of the monetary policy failure or the risks of a failure or being behind the curve in the US, or in some other jurisdictions saying, well, is monetary policy becoming less effective in terms of encouraging the recovery? So there are two sides of that same coin in that particular context. Now, one which I think is certainly relevant in most forums that I visit and speak to is this issue or the concept of what's the impact of the oil price, and is that going to have an impact on global inflationary pressures? Because, of course, we have seen that substantial uptick in the oil price, or we saw that through Q4 and into the early part of this year. Would that create what's called stagflation, so i.e. inflation moving much faster than the growth trajectory? Is that a real risk? Well, I don't think it actually is, but I think we have to be mindful of it. I think the reason why it isn't a risk is because of the changing dynamics in terms of the oil spectrum, in terms of the swing producers or the swing production, now moving much more towards North America and away from that over-reliance on the Middle Eastern producers. So I think absent a significant geopolitical shock, which would probably imply some kind of terrorism risk, taking out supply in the Middle East, absent that, then I think it's very difficult to see a durable increase in the oil price above a $60 threshold over any period. Now, what are the risks? Well, China is an obvious and an inherent one which I'm always asked about. Is there a concern about an implosion in China? Are the non-performing loans going to be an issue? Are we seeing a significant degree of overinvestment in unproductive capacity in China? Well, yes, those questions are relevant. There are questions about the validity of the data, and I'll touch upon that a little bit later. But I think the risks are sufficiently modest to say that China isn't the major implosion story over the course of the next year or two. Next 5 years, then perhaps we will see greater stresses and strains, particularly as the demographics continue to move against China. But overall, I think the backdrop is relatively benign there. And then I think the final risk is perhaps the most interesting one, or the most worrisome one, depending on one's point of view, and that's those geopolitical risks. And I say that again, obviously, in a week when we have Trump meeting the Chinese premier. He's been promising over the last few days to sort out North Korea. I'm not quite sure what that means. Certainly in the Twitter sphere, it doesn't sound particularly helpful, but clearly that could be a geopolitical risk that we need to consider. And at the same time, we have China and Russia trying to reassert their military superiority in their spheres of influence. So those are particular tail risks just to consider. Now, how does that translate into risk and risk appetite? Now, this is an index that I've put together just looking at a sort of a barometer of underlying market risk appetite. And this is just looking on a week-to-week basis, hence the very sporadic moves in the levels of risk appetite. But when we do see those very sharp spikes to the upside, that's showing when markets are very fearful about ongoing or underlying macroeconomic scenarios. Now, if you looked at this particularly, you could see in terms of the time horizons for Brexit, the Chinese vote, the November presidential election, we've recently seen risk appetite starting to underperform or become compromised because, again, there are some question marks about the US equity space. So we've been seeing equity market volatility starting to pick up, and that's been leading through to a degree of risk aversion. But really, the fact that we haven't seen a protracted spike in risk aversion, as I say, comes back to this presumption that global central banks will be always there to remind the markets that risk needs to be kept into some degree of context. Now, what does this all translate to in terms of the global economic backdrop? Now, these are the numbers that I work with our economics group, who are based in Toronto. And these are the assumptions that we're looking at over the course of the next couple of years. Now, the first point I'd make is that if you compare the numbers in the columns on the right-hand side of the table and compare those with the column on the left, you can see there is a big differential. We're not seeing anything like the magnitude of growth in the next couple of years that we saw in the 5 years prior to the crisis. Now, in a sense, I think that's the realization that we are in this new normal. Not sure it's quite so negative as a secular stagnation, as some might say, but the new normal is a slower growth trajectory that we have been accustomed to. And I think that's something that politicians have yet to necessarily get their minds around, but of course it does have important implications for fiscal backdrops in terms of tax and revenue raising, for example. But we are seeing the global growth numbers this year north of 3%. Why does that matter? Why is the 3% level important? Because that's the sort of number that is required in order to generate global growth or global wealth accumulation on an aggregate measure. So in order to say that the global economy is really becoming wealthy, we really need to see a sort of a global aggregate of around 3%. So we're beating that this year, but perhaps we might struggle to beat it substantially through the course of 2018. But looking at the individual dynamics, well, we do have an uptick in the US, but we're not going to get the sort of growth numbers that Mr. Trump would like or would argue he should be expecting in the line of some of the comments that he was making on the campaign trail. So yes, we see an uptick, but not to the sort of levels that he might wish. And I think that's going to be fascinating because, of course, although we've only just had the election in November, we're already starting to think about those midterm elections in late 2018. And if we're not seeing growth sufficiently north of 2.5% towards 3% in the US, then we may not see the sort of job creation in the Rust Belt that was really beneficial for him becoming the president in the first case. So I think that's going to be an interesting dynamic. In the Eurozone, well, we're seeing growth of a moderate level through the course of this year, slightly slower next year. I think the point that we would make on Europe is the fact that the speed limit for Europe PLC, if we can call it that, is relatively low. So in fact, the Eurozone is probably growing pretty close to its trajectory or its aggregate level over the course of the next couple of years. Now, I think it's interesting, just in terms of the China growth numbers, as I say, there are question marks about the validity of the data. And of course, the Chinese are wonderful that they can produce their growth numbers pretty much about 2 weeks after the end, at the end of each and every quarter. Most other statistical agencies across the world take a month or two at the very least to have a first stab. Now, either the Chinese are very good at it, or alternatively, they work out what the number should be and then work back from there. But nothing's really changed in that particular context. And so in a sense, unless you think they're cheating on their numbers is significantly more aggressive now than it was a year, 2 years, 5 years ago, then I think you have to look at the trend in terms of China. And I would agree entirely with the point made by the previous panel about the aggregate size of the Chinese economy is really what matters rather than the relative growth rate. Now, just looking at, again at another way of sort of cutting and slicing and dicing the sort of a global economic recovery, where we can see leading indicators in a number of economies have moved up very dramatically. The bright green line here relates to Brazil. So obviously Brazil being a nation which had enormous structural and political problems which hit sentiment in the economy very hard. That's rebounded quite aggressively. And we're seeing most of the other emerging markets, as well as the US, looking substantially better. Now, India perhaps is a slightly less constructive story. There are obviously some political dynamics there, but again, the Indian growth story is probably still going to be reasonably constructive, which I guess is important for the fabrication story in relation to gold. Now, let's just look at some of the important individual dynamics, and then before we get to just a little bit of a wrap-up in terms of how that relates to gold. We're looking at the US and looking at the duration of this economic cycle. This current upswing is now the third longest in history, going back to the late 1800s. So in a sense, we are in a very extended period of economic expansion. Now, you can argue because of the nature and the extent of the downturn in the post-crisis world, of course the recovery should be long and it should be relatively protracted. And indeed, I think we are set fair to actually test that all-time high that we saw in the post-1991 recovery process. So we are in a very protracted process. The average over that whole period is 40 months. Post-war is 60 months, so a 5-year recovery cycle. We're well in excess of that. And in a sense, that underlines the fact that perhaps the Federal Reserve are getting a little bit behind the curve if they don't push through with at least 2 more hikes through the course of this year. Now, what does this all imply for the US dollar? Because, of course, that is relevant for dollar-denominated commodity prices. Now, what we would say is that the US dollar tends to move in long-term 6- or 7-year cycles, and we were in a relatively mature cycle as we got through towards the end of last year. So we've seen a couple of these going back into the late 70s, in the 90s, and again, we were, as I say, getting towards a fairly mature period at the back end of last year. Now, in a sense, I think the Trump presidency and all the legacy of that uptick that we've seen in asset markets as a consequence of that probably has extended the duration of the dollar's resilience a little longer. But it is just a case of an extension of a mature phase, and I think there is going to be a scenario where the dollar will be somewhat cheaper over the medium run. So I think that obviously has some implications for commodity prices in general. Now, I touched on a little bit earlier that the Federal Reserve wouldn't be necessarily overly concerned about the valuation of the dollar. In the context of the dynamics of the US economy and the importance of exports within that, that would be borne out by this particular data, where we have a very modest contribution of exports to the overall GDP dynamics of the US, because, of course, it is a large economy which is generally incorporated by its own domestic demand. So in this context, contrasting that with the Eurozone, with the UK, and obviously with Canada, if you actually looked at some of the Asian emerging nations, then the export dependency is infinitely higher. So in this context, that would argue, as I say, that the Federal Reserve will not be overtly concerned were the dollar to appreciate if rates go higher, but the US administration, Mr. Trump et al., would be much more concerned. But the other element that I would also say is that we tend to find that the US dollar tends to rally best or most significantly ahead of the start of the cycle rather than necessarily during it. So even if we assume that the Federal Reserve are going to be hiking rates over the course of the rest of this year and into 2018, that doesn't automatically imply that the US dollar will continue to appreciate exponentially. And I think also you need to think that currency markets are bilateral, and you need to think about some of the other dynamics on the other side of the equation. In that context, that puts much more focus on the euro as we go forward. But just in terms of how markets are positioned, I think it is relevant because it gives you an interpretation of where we are now and gives you a guide as to the overall levels of appetite and interest in any particular currency. So this is looking at the way the market has been positioned in the US dollar over the course of the last 2 or 3 years. Now, when we have the bars above the line, that's showing that markets are buying US dollars on a speculative basis on the presumption that that US dollar valuation will go up. And conversely, when those bars start to diminish, that's in line with a negative trend or a presumption of a much more negative backdrop for the dollar. So we can see that through the majority of this period, markets have been pretty optimistic on the US dollar, and indeed we have seen a significant uptick through the course of the latter stages of last year. But even now, with the prospect of more tightening to come from the Fed, we're nothing like the sort of extremes that we saw at the back end of last year, and certainly nothing like the extremes that we saw prior to that first hike in December 15. So markets are optimistic on the dollar, but not exponentially so. And I think that's relevant because we're not anticipating, or certainly the markets are not assuming, that this tightening cycle is going to be so dynamic that it's going to drive the dollar significantly higher. I think interest rates and interest rate expectations, not just in terms of the Federal Reserve, but in terms of longer-term interest rates, are also relevant here. So markets had been assuming, or at least trying to anticipate, that long-end yields in the US will be heading towards 3%. But they found that, in fact, once again, that process has not been fulfilled, and we are seeing rates holding down at a much more manageable level and certainly not rising so significantly. So if the market is optimistic on the dollar, but not overly so, and I think the prospect of that monetary tightening isn't going to be the exponential factor which is going to drive the dollar significantly higher. But of course, the other element, the other big variable in terms of the FX space is what's happening to the euro, because that's the other big liquid currency block. That's the other side of the equation which we need to consider in terms of the bigger picture story for the dollar. And so in the context of the way the market has been positioned, the converse to what we've seen in the US has been the case, largely in the case of the euro over the course of the last 3 or 4 years as well. So we've seen consistently investors saying, well, we don't like the euro, we expect it to remain relatively cheap. So those bars have been very largely heavily below the line over the course of that period. But what we are seeing and have seen is, in fact, that negative view has been increasingly compromised over the course of the last few weeks to an extent that we're back to levels that we haven't seen since around May 2014. Now, that's despite the inherent political risk, which I'll come on to in a moment. And that's perhaps slightly counterintuitive. You would have thought, amidst the current political risks, and there are still multiple political risks across the Eurozone through the course of the calendar year, you would have thought that perhaps the markets would be a little more circumspect and not necessarily looking at a better or a slightly more optimistic scenario. And I think what that really implies to me is that the fundamentals in Europe look better. I think they probably look as good as they have since probably 2011. And if you can remove those political risks, then that implies that the euro will be substantially higher. And I think that will have implications for the dollar as a whole. Now, what are these political risks? Well, of course, if I was standing here a month ago or just before the Dutch election, then I think that would be clearly a political risk that was causing a great deal of consternation in markets. The fact that we've moved through that election without the worst-case scenario of the far right becoming the largest party, I think has alleviated or limited some of the stress in financial markets. And indeed, whilst we are still very mindful of the risks of the first round of the French presidential election on April the 23rd, seeing Marine Le Pen becoming the largest individual party, I think the realization is still, in financial market terms, that we won't see Marine Le Pen becoming the French president after the second round on May the 7th. There is still this realistic presumption that we will see, most likely, Emmanuel Macron becoming the French president. Now, of course, that's based on the opinion polls. And the opinion polls didn't prove to be particularly accurate in June in terms of the Brexit vote. And of course, there was a great deal of uncertainty in the opinion polls into the US election as well. So we have a lower degree of conviction than perhaps we would have done this time last year. But assuming that we don't see a Le Pen victory in France, then those political risks, I think, will continue to diminish. We're not expecting Angela Merkel to be defeated in Germany, but even if she were, yes, it will be headline news, particularly for investors outside of Europe. But overall, you're not going to see the dynamics of the European model or the European Union changing dramatically, even if we were to see the SPD and Martin Schulz becoming victorious. So removing these political risks over the course of the next few weeks should provide a much more constructive backdrop for Europe going forward. Now, how do we graphically represent these political risks? Well, we can see them writ large in the context of the way that the interest rate spread between French bonds and German bonds has been trading over the course of the last few weeks. So when we've seen the spread moving substantially wider, that was when we were seeing the worst-case scenario, or the market becoming aware of the scenario of Le Pen potentially doing rather well, at least in the first round in France. Now we've seen a somewhat of a more moderate assumption as to the risks of her winning. Then we've seen the spread or the differential between long-term interest rates between France and Germany coming back from recent extremes. Now, what about some of the other dynamics that are relevant for the Eurozone or for the Euro as a whole? Well, what about the balance sheets of the two major global central banks, the Federal Reserve and the ECB? So the ECB have been gradually increasing the size of their balance sheet over the course of the last few years as they've been buying government bonds under their own QE program. You can say, well, that's broken any number of treaties which were created prior to the advent of the euro. Well, yes, but the desire to maintain the integrity of the Eurozone was much larger or much stronger than the rules and regulations that were designed around it in the first instance. So we've seen this balance sheet expansion of a fairly significant nature. That's been one of the reasons why the euro has been much cheaper, why it has depreciated over the course of the last couple of years. Also, when you overlay that with negative interest rates in the Eurozone, and that proved to be particularly problematic for some of the global reserve managers, some of the major central banks, who couldn't hold reserves which had a negative yield, then that's really encouraged the euro to remain relatively cheap. Now, that process of balance sheet expansion is starting to slow. The ECB is now reducing the amount of bonds they're buying on a monthly basis from this month. And we will see that process probably continue to moderate as we go through into 2018. Now, of course, the political risks were one of the concerns that I think the ECB were very mindful of. But I think as those political risks moderate and we see the broader macro position remaining constructive, then that will see that balance sheet expansion slow and then eventually end. And I think ultimately then that has implications for the way the euro will perform. Now, this is a long-term chart of the euro. Now, those that have looking at the axis here will say, well, actually, the euro didn't exist in 1980. Well, of course it didn't. But I created the sort of a synthetic basket, if you like, from the old traditional legacy currencies and put that together in terms of a long-term valuation metric. And we can see that in an equilibrium term, and that's the red line there, a sort of a fair value metric for the euro against the US dollar, we've seen these three episodes where the euro has been very cheap. So we're seeing one of those now, where the euro is substantially below that equilibrium line. The equilibrium line, as mentioned there, probably, according to my estimates, is around 128. So substantially above the sort of level that we're seeing now. That's one of the reasons why the German export miracle has continued to grow and expand, because the euro is remarkably cheap. Certainly, on a relative basis, you could argue that this is a Eurozone aggregate measure, this red line. If you looked at Germany in isolation, the numbers would be substantially higher. So we are seeing a very cheap euro. We have seen the ECB injecting liquidity. We have seen negative deposit rates. So a very virtuous backdrop for the Eurozone. And I think that's now starting to have an impact in terms of the macroeconomic outlook. Now, what about inflation? Because, of course, the ECB is an inflation-targeting central bank. Are they going to be concerned about a spike in inflation? Well, the blue line here does show inflation expectations. They have moved up quite dramatically, or they did move up quite dramatically, largely as a function of the oil price rallying very significantly. Now we're just seeing a little bit of a moderation. But I think what we would argue from this particular chart is that even though inflationary expectations or deflationary concerns, because of course it wasn't so long ago that we were all concerned about prices going down rather than going up, but those inflationary consequences are still relatively moderate. So we're not on the verge, as we stand here today, of likely seeing a significant splurge in inflationary pressures over the medium run. So again, that has some implications for assets, and particularly in relation to gold as we conclude. Now, I'm not going to talk about Japan for too long, other than it has some important relevance for gold prices per se. But we have seen, again, looking at that right-hand graphic, some significant degrees of variance in terms of valuation concerns over the course of the last couple of years. We saw an incredibly strong yen, and we actually saw an agreement or a tacit agreement by the international powers to allow Japan to cheapen up their currency quite dramatically. And we're now not materially away from a fair value metric. But I think what we would say is that the US administration are not going to allow Japan to have a free lunch. And by that context, what I mean is they're not going to allow the yen to cheapen up substantially from sort of current levels. And indeed, I think there may well be a case to say that the yen will appreciate a little bit over the medium run. And as I say, that has some dynamics in terms of the gold price. Now, again, just looking at the way the markets are positioned, so we've seen largely negative views in terms of the yen, particularly over the course of the last couple of years, as the Japanese were actively looking to cheapen up the currency. We saw a period of that risk-based uncertainty in the middle part of last year, creating a rather different backdrop, and now we've moved back to assumptions of a cheapening up of the yen, but those expectations have moderated, and I think over the medium run that probably makes sense. Now, what about the UK? Now, I can't go in any meeting or event these days without talking about the UK, coming from the UK as I do, being party to the Brexit process. Well, how bad are things going to be for the UK? Well, I don't think it's going to be a doomsday scenario, but nevertheless, it is going to be a rather troubled environment for the UK. Growth trajectories are going to be lower. We've taken a percentage point off our growth forecast for the next couple of years, and we are going to see ongoing risk parameters. Now, sterling has fallen. That's repriced. That's good news for exporters. But that's only a relatively small component of the overall GDP perspective. And I think there are other sort of particular concerns in relation to the financial markets, the primacy of the City of London, which I represent, or I'm certainly party to. And there are other particular concerns in relation to the global and growth dynamics. So clearly, I think there are some ongoing issues which are going to be relevant for the UK. And I think it is going to be a case of dealing with those parameters as we go forward. We didn't expect the Brexit vote to go as it did, but we did put out a piece a couple of weeks before the event, saying that in the event of a vote to leave, that we would see a substantial depreciation in the value of sterling. That's very much what we've seen, and I think now we're in a situation where sterling is reflecting and underlines the realization of some of the challenges ahead as far as the UK is concerned. So against the US dollar, if you thought prior to Brexit that 140 to 160 was a relatively equilibrium sort of trading range, I think that trading range has moved lower to around the sort of 120 to 160 mark. Now, again, just looking at the way that the markets have been positioned, not really that surprising, very, very negative scenario playing out as regards the valuation of sterling or the outlook for sterling. It has been a clear consensus trade in financial markets over the course of the last year or so, and indeed we're still holding on to almost record levels. And in a sense, that's the one sort of crumb of comfort for the UK, is the fact that the market is already discounting pretty much the worst case scenario for the UK. So unless the divorce negotiations, which are just on the cusp of getting started, are really fraught and very discouraging, then I think we are pretty much discounting already the worst case scenario. Now, some of the issues in relation to the underlying dynamics for trade, well, the UK does run an enormous trade imbalance with the majority of Europe, or predominantly with Germany. So clearly there are question marks as to whether there would be risks or parameters which would be detrimental to both the UK and the Eurozone if there were to be a worst case scenario on tariffs or trade barriers being erected as the result of the post-Brexit world. And in a sense, that probably does suggest that there will be a degree of pragmatism over time. But I think because we're dealing with politicians here, and we're dealing with politicians who often have their own domestic constituencies to deal with, particularly when there are elections, then I think that pragmatism will take some time to come through. So I think there will be a lot of headwinds to be ridden through prior to that. Now, just finally, in terms of China, and particularly in terms of the rise of China and in terms of its importance, again, I come back to that argument that the rate of growth may be slowing, but you're talking about an ever larger economic process, which is really continuing that rate of expansion over the medium run. So we are seeing, or we are on the cusp of seeing, according to the IMF estimates, the importance of the Chinese economy to the global economy on the verge of overtaking the US. Now, I don't think we're realistically there. I think the IMF numbers potentially overstating that importance of China, but I think it is an important dynamic to consider. Again, just looking at the growth trajectory, and I think it is just worth, again, repeating that we're not seeing the sort of growth numbers that we've become accustomed to, but we shouldn't expect that. We are seeing a changing orientation in the Chinese economy. They're moving away from that low-cost manufactured export dynamic, which has really driven growth in the early stages of the 90s and into the early part of the 2000s. We're seeing more orientation in terms of service sector. We are seeing the enhancement of the middle class, and so that does come back to that idea of continuing consumerization and or demand for products that we are associated with in the West. So whether it be cars, whether it be televisions, whether it be washing machines, or whatever. So I think that's an important dynamic, and it's the case of the quality of the growth rather than the quantity of the growth that we should be considering. As I say, in the week that we have Trump and or the Chinese Premier meeting, I think it's relevant that the Chinese trade cycle is turning or has turned. Unfortunately, Mr. Trump doesn't seem to have recognized that. So I think that's certainly something that we keep in mind. But what does that mean? What does that mean for gold? And as I say, I'm not a gold expert. I'm not a gold miner. I'm not a gold producer. I don't have a particularly strong bias in terms of the gold sphere. But clearly, we know it's a mined precious metal. We know that the demand, or the supply remains relatively inelastic. That's probably a rather unfortunate thing to say in a room where there are a number of miners, but effectively the supply is relatively contained. And that, of course, contrasts with nominal currencies. The traditional currency, which is not backed by anything hard, so what's called a fiat currency, so it's really backed by the support of the government in individual nations. Well, of course, as we know in certain jurisdictions, in Zimbabwe being a most obvious one in recent history, if governments lose credibility, they have a tendency to print money in order to get themselves out of their own particular holes, and that creates inflationary pressure, where there is then a demand for a hard asset. So there is this question as to whether the gold price will continue to be seen as a hedge against these inflationary consequences of fiat currencies being gradually debased. Now, we're not expecting to see that in the global perspective, but I think that's certainly something to keep in mind. So what for me drives the gold price? Well, I think, of course, it generally moves inversely with the US dollar, so my view on the US dollar is relevant to what it implies for the gold price. As a zero-yielding instrument, as touched on earlier, if we are going to see higher interest rates, that has important implications. There is this issue of a hedge against inflation. Well, if we were to see global inflation moving up dramatically, I don't see that happening. But if you were to see that happening, then the gold price would be seen as a beneficiary of that. And of course, there is this risk aversion element. Again, that sort of flight to safety or a hard asset. So what are the influences telling us? Well, I think in terms of the gold correlation with the US dollar, if you're looking at the broader dollar index, the correlation tends to work in periods, but not totally over a prolonged period. So the blue and red lines in the left-hand graphic work well in the near term, and they work well in the sort of the 2012-2013 period, but there was a big dislocation in the meantime. And of course, that's because the dollar index is heavily weighted in terms of performance of the euro. If you're looking against the Japanese yen, though, there is a much better correlation, and that's why the performance of the yen, or the outlook for the yen, is important. If we are going to see a stronger yen over the medium run, then I think that does have some implications for the gold price. So what do we think of the gold price influences, well, the metrics? Well, we think they're mixed. And I think that's really the way that we would sort of characterize it. In terms of the medium run, so over the next 1 to 2 years, we expect the dollar to be a little cheaper, i.e. losing some value. That's supportive for the gold price. Conversely, we are expecting those Fed hikes to come through over the course of the next 6, 12, 18 months. So that, of course, moves in opposite direction to the gold price. And then we're not assuming that we're going to see significant upticks in inflation. So in a sense, you've got the broad dollar story being supportive for gold, you have the influence of the Fed being negative, and then you have the inflation story not providing us with any obvious signal before. And then you're left with the final variable, which we can't really model, and that's, of course, the risk aversion or the geopolitical risks. And that, of course, gets us into the realms of the known unknowns of the Donald Rumsfeld scenario. So forecasts, I always have to provide forecasts because that's my job. Most importantly, though, if I am going to show you some forecasts, I'm going to show you some small print because there are always lawyers in the room who are always keen to come back to me after the event when I've shown you some forecasts. In terms of the numbers, well, as I say, the dollar story is going to lose a little bit of momentum over the next 12 months. And I think if we were extending these trends out to 18 months, that process would move a little further. So I think that suggests that there is a cautiously optimistic story for gold. So these forecasts are not mine. These are from my colleagues in the economics group, and they're expecting the gold price to oscillate in this 1,200 to 1,250 range over the next year or two. And I think that probably still makes realistic assumptions on the basis of my global recovery view and in terms of the broader dollar dynamics. Now, I'm conscious that I've kept you from the bar for far too long already this evening. I'm happy to take questions from the floor. I hope that I provide you with a little bit of an overview of some of the things and thoughts that we're having from CIBC. And if people don't want to ask me questions from the floor, I will hang around after the event if you would like to attack me privately for my views, or even better, agree with me. But with that, I will thank you very much for your attention.